Hello and welcome to Market Domination, sponsored by Tasty Trade Friday edition. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
There are a whole bunch of revisions that take place in January for the previous year. Now that said, I think this was a solid report. It was close to what was expected. The unemployment rate ticked down a little bit, taking all the broad measures together, because we got some question marks on any one of them. Taking them all together, to me, it really feels like it shows we're settling into something like full employment.
The Fed's going to be on hold for majority of the first half, potentially looking to renormalize later in the second quarter. And of course, inflation is going to be muted. So what does that mean for markets? It means that risk is actually going to do well here. And so we do like risky assets here. And then you can kind of pull in duration when you need to if you see some of those tariffs, tax cuts, and term premium play out into the market.
Pretty solid quarter. 4Q beat on revenue and crushed on op income, and so all in fine. So it's down a couple percent today. Let investors regroup, and it should still be a really good year for Amazon shares.
We got 1 hour to go until the market close. Taking a look at the major averages here today. So obviously we had a jobs report this morning. The headline number a little bit below estimates at 143,000, but the unemployment rate ticking down to 4%. Most economists saying nothing there sort of sounding the alarm. What did sound the alarm, however, potentially, was a consumer confidence report that we got from the University of Michigan, which showed the lowest reading in 7 months and a big uptick in inflation expectations. So that really seemed to be sort of the turning point for the market when we started to see things slide lower in more decided fashion. The Dow off almost 1%, 452 points. The S&P 500 also off almost 1%, and the Nasdaq down 1.4%.
To your point, it seemed like investors sort of took the jobs report in stride, because I don't think there was anything in there that just sort of shook the overall narrative of a kind of cooling but not crashing report. As Goolsbee was just saying there, I mean, overall solid. The unemployment rate ticked down, positive revisions, right? Hotter wage number, which I thought was interesting. But to your point, Julie, it was the sentiment data. I mean, that was the curveball when confidence dips like that, and then that jump that you saw in 1 year inflation expectations, that was an unusual jump there.
Right, definitely. So let's look at some other areas where this is playing out here. I want to check on the bond market in particular. As we see stocks going down, we also see some selling in the bond market, yields ticking up a little bit, still 4.5%, just under, not a crazy level here. But speaking of curveballs, if there's anything consistent or regular about this White House, it's the curveballs. It's the regularity of the curveballs. And today, President Trump saying that we will hear about some sort of reciprocal tariffs maybe for the EU next week. But he also, in a press conference with the Prime Minister of Japan, floated the possibility of tariffs against Japan. And so you saw some movement with, this is the dollar versus the yen. So there's sort of some gyrations here as investors tried to figure out what to make of that latest.
And not just currencies, but look at some of the names. Say, look at letter X, U.S. Steel, which has been whipsawing on these reports and headlines. I mean, it was actually positive because there was reports, well, maybe Trump would let the Nippon deal go through, so we were gaining, but then Trump seemed to come out and kind of shoot that down. So this one has been all over the place.
Yeah,
you're watching
trenders, and we don't, but we're going to talk about this.
We're going to talk about this. If you're in that space, you're watching X. You're also watching other names too, like Cleveland Cliffs, for example, as well.
Yeah, and I just wanted to check on big cap tech as well here today, because we got Alphabet down 3%, Amazon down 4% after its report. It also unveiled big spending plans. It also disappointed with its cloud revenue. The share's down 4%. Tesla, which has had a pretty remarkable slide as of late, but all of the Magnificent Seven, except for Meta.
Yeah.
Look at what's been going on with Meta here. We don't have the 15-day chart, the 15-day trading chart for the stock, but it's up for 15 straight sessions, which is a record as we've and it's really resistant even to the selling pressure that we're seeing today, which is
you point out those big cloud players too, Julie. You've now heard from all three. Amazon, as you said, AWS sales showed no acceleration there, right? And there was, it just kind of echoed what you heard from Microsoft and Alphabet Clouds. You see all three are down. We're going to talk to a tech analyst later about that as well.
We are. All right, the market is digesting this morning's jobs data, continues to do that. Chicago Fed President Austin Goolsbee talked to Yahoo Finance earlier today, sharing his feeling and his perspective on the January jobs report.
We may be on hold, but I see over the next 12 to 18 months, if we can get out of the uncertainty from coming from policy or from geopolitics and commodities, I view the long run settling rate for the Fed funds rate to be a fair bit below where it is today.
For more, we're bringing in Greg Dacco, EY chief economist. Greg, it's good to see you. You know what? I'm going to do a little bit of an audible here, because we just heard Austin Goolsbee talking about rates going lower, but man, people, individuals, consumers, they are not expecting inflation to go lower. We learned from that University of Michigan report today. That seems to be the real shock to the market and to sort of the economic paradigm today. What did you make of that?
That's right, Julie. I mean, we have an environment in which the expectation of tariffs, potential tax cuts, and deregulation are seen all as inflationary. And that's a little bit of the paradox, because there was this sentiment up until the election that inflation was a key concern coming from the general public. So having these inflation expectations that are rebounding very aggressively, you saw the University of Michigan 1 year ahead inflation expectations surge 1 full percentage point in early February. Those are not encouraging, because they tell you that consumers are going to be much more judicious when it comes to their outlays. And even though we still have a robust labor market, as was shown this morning in the data, we have to be conscious of the potential risk for a downside there in a higher inflation, lower growth environment.
Greg, on that sentiment data, that jump in 1 year inflation expectations you're calling out there, and which, as you know, eye-catching, unusual, what do we attribute that to, Greg?
Well, I think it was largely attributable to the fact that people were looking at the announcements on the policy front and the expectation of tariffs raising or leading to an increase in consumer prices. I think we are now in this environment where more and more consumers are in tune with the fact that if you impose tariffs on your trading partners for automotive goods, for agricultural products, for furniture, those prices of those items will go up, and that will lead to higher inflationary pressures. That's really what the University of Michigan Consumer Sentiment Survey was indicating. Encouragingly, though, we still have that robustness in the labor market, and we still have the luxury of non-inflationary wage growth that is coming from the labor market and supporting incomes, which in turn are supporting consumer spending. So we're not at risk right now, but there are some potential cracks there forming.
Well, Greg, and that raises the question, too, of, the whole argument over the balance between tariffs being inflationary, but also being a risk for growth. It sounds like you're not worried about the growth side at this point.
Well, at this point, not yet. But if you factor an environment in which prices are rising, that will be fed through to consumers. We know that we're coming out of an unusual period of high inflation where pricing power surged to levels that we had not seen in multiple decades. So if we are to see this environment where tariffs are imposed on our major trading partners, whether it's China, Mexico, Canada, Europe, that will lead to higher producer prices, which will be passed on to consumers. And in an economy that is evolving close to full potential, as Austin Goolsbee was saying earlier, we have a labor market that's also close to full employment. In that type of environment, any type of supply disruption risks creating more inflationary pressures and becoming a hindrance in terms of economic activity, and therefore a drag on economic activity. So I think we very much have to be conscious of this potential hit to economic activity from tariffs.
Greg, back to the jobs report. I think broadly solid, investors seem to take it in stride. How do you as an economist see that labor market evolving in 2025, Greg? Or is it tough to say with any degree of great confidence until you get more clarity about immigration policy?
There's a lot of uncertainty, certainly, Josh. But if we have to describe this labor market, I would essentially say that it's robust but frozen. We have job growth that is still relatively steady. If you look at the 12-month moving average, it's around 170,000 jobs per month. You have an unemployment rate that is everything that you want it to be. It's reassuring, it's driven by a high labor force participation rate, and it's at a historical low of 4%. These are very encouraging indicators. But there are some elements that we have to focus on. Hours worked fell to their lowest level since the COVID crisis. You have an environment in which you're seeing less diffusion of job growth across sectors. And the January report was slightly softer. So there are signs that businesses are being cautious with their hiring decisions. They're not firing and laying off individuals without discernment. They're being very strategic with those. But at the same time, they're also being very strategic with who they hire and at what rate they hire. And that is the type of labor market that's frozen that we're currently seeing.
And is that a function, Greg, of what's going on in Washington? Is that a function of economic conditions, some combination of the two? What do you think?
I think it's a combo of the two, because we were already starting to see the initial elements of this frozen labor market over the course of the past year. If you look at the hiring rate or the quits rate, there's much less churn today than there was a year ago, 2 years ago. And even if you look at these rates, they're at a 10-year decade low. So these are indications that the labor market has been cooling for the better part of the past year. But add to that the uncertainty with regards to policy. What type of trade policy, tax policy, regulatory policy, immigration policy environment we're going to see over the next year, over the next couple of years. And that makes it very difficult for business leaders to decide whether to pursue growth strategies, invest more and hire more, or adopt more of a wait and see approach. And I think right now, the latter is still dominating. A little bit of that wait and see approach until they know what type of policy environment they'll be facing for the next few years. And unfortunately, that's to some extent restraining economic activity in the early stages of this administration.
And it's also not clear when exactly all of that will be settled, Greg. So I guess we'll catch up with you again soon as we make progress, hopefully.
Sure.
Thank you.
Thank you.
We're also watching shares of U.S. Steel on a wild ride today as a drip of headlines out of the White House are driving the action. Now, earlier in the session, the stock spiked on a headline from CBS saying that President Trump may allow the highly contentious sale of U.S. Steel to Japan's Nippon Steel. But a short time ago, President Trump said this, and the stock sold off and was halted.
Nissan's going to be doing something very exciting about U.S. Steel. They'll be looking at an investment rather than a purchase. We didn't like the idea. U.S. Steel is a very important company to us. It was the greatest company in the world for 15 years, many years ago, 80 years ago. And we didn't want to see that leave. And it wouldn't actually leave, but the concept, psychologically not good. So they've agreed to invest heavily in U.S. Steel as opposed to own it.
Now, while he did say Nissan there, it seems like he misspoke and meant Nippon Steel.
Yeah, the context was there, right?
The back and forth over the investment and sale are about Nippon. This coming after U.S. Steel's CEO met with President Trump yesterday at the White House. So obviously a lot of back and forth here, but the idea that it wouldn't be an outright takeover, just an investment, is something that has investors' heads spinning at this point.
Well, yeah, and you've been trying to follow the headlines. You've been trying to follow the stock of letter X, which has been all over the place on different reports, headlines. It was green, now it's back to red, as he sort of kind of suggested to shoot down that deal. Now suggesting would be more, again, he said Nissan, but he meant Nippon, we believe, making more of an investment.
Right.
Was how he was framing, which he said he would find exciting in that degree.
We'll see if that is what.
I'm also, as we discussed, I mean, you're also, as you're following story, you're just watching other players too. And you're watching Cleveland Cliffs, for example, we're down more than 3% right now.
Yeah, great point. We're just getting started here on Market Domination. Coming up, we're speaking with the CEO of the latest company to make its public debut, Titan America. Those shares began trading at $16 earlier today. They're trading higher. Plus, in the 4 p.m. hour, we'll be speaking with ARK Invest CEO and CIO Cathie Wood to discuss her latest holdings and big ideas for 2025. And at 4:15, we catch up with Affirm CEO Max Levchin following his company's latest earnings results. Lots to come, folks. Stick around. Much more Market Domination coming up. Now, time for some of today's trending tickers, sponsored by Tasty Trade. First up, we got to look at Uber. Shares of that company riding higher as Bill Ackman's hedge fund reveals a stake in the company worth about $2 billion. Ackman being Ackman, he revealed this in a posting on X. He talked about holding about 30.3 million shares. I was looking through the data on Bloomberg. It looks like that would make him the 12th largest holder. And he says he likes the company, but it sounds like he's still maybe going to weigh in on some advice for them potentially.
Has advice, helpful tips?
Well, he just says we will have more to share about our thinking on the company shortly, whatever that entails.
Maybe some advice on Uber Eats. You know,
you think
well,
he's
the
a big
fries
Uber
sometimes
Eats
come. They're
orderer?
kind of cold. You know, maybe that's what he's talking to Dara
I feel like
about.
Ackman probably has his own chef at
It's
home, don't you think?
Yeah. Ackman, by the way, we should say this was, by the way, just kind of an interesting period for Uber because we talked about this. They did recently report results and kind of muted gross bookings outlook for the first quarter. The stock actually got hit on that.
Yes.
Pretty good, but we're up 8% today.
Yeah, and the stock hasn't done much over the past year either, by the way, until today. I will say also Derek Khosrowshahi, the CEO, he replied to Ackman's post on X,
What did
and
Dara
he
have
said,
to say?
thanks for making a bet on us, and super excited to have you on board as a shareholder. And he said, by the way, Bill has called me many times with observations
there it is. Yeah.
and suggestions regarding our service. He is a power user consumer
Helpful
of the
tips.
product. There you go,
Has some
cold
things to
fries.
say.
Look forward to engaging with you and your team, he said.
Sure.
So this seems very amicable at this phase.
So far. All right, doing a double take on shares of Take-Two Interactive, the stock surging as the company surpasses third quarter earnings estimates. So let's dig into this one. This is jumping in today's trade. Highest, look at that, 15%. Highest intraday level since February 2021 for this one. Reiterated the full year net bookings guidance, and critically for the gamers, this was really it. Reiterates its plan to launch the highly anticipated Grand Theft Auto 6. Says yes, fall of 25, it's coming.
Yeah, there were some concerns over that timeline. So that's why there's so much relief being expressed in the stock today. And it seems like gamers and analysts are equally enthusiastic about that. So that's what a lot of the commentary was around. But there was also a lot of commentary around NBA 2K. That growth there reaccelerated, according to an analyst at Morgan Stanley, Matthew Cost. He says NBA 2K saw growth reaccelerate to levels not seen since the fourth quarter of 2021. And he said that was because of things like new game modes and returns of certain features in the game, like Auction House, which I don't know what that means, but apparently it's something that people like in NBA 2K. Are you a gamer at all, Josh?
I'm not
I
a
don't know
gamer.
this
I'm
about
not
you.
anti-gaming, but I'm not a gamer
Yeah,
myself.
I mean, I'm not anti-gaming either, but I'm not a gamer either. Same page. All right, companies tied to EV charging taking a hit after President Trump halts federal funding for electric car chargers. And this was a Biden administration plan, of course, to infuse $5 billion to build out a charging network across the country. And so the administration now saying, nope, this is among the many, many different programs that it has halted. It dispersed, was planning to disperse money to the states to build out these networks. And it sounds like some states reportedly, according to the Washington Post, for example, says maybe Pennsylvania is still keeping the plan that's in place for its build out, but it's unclear what's going to happen elsewhere.
Yeah, and Trump did make it clear on the campaign trail, he was going to rescind Biden EV initiatives and initiatives talked about. Yeah, I think he even made it clear when he made his address to the Republican National Convention, and it came up So of course, there's the Elon Musk element to this, which is interesting too. So you have Tesla, of course, big EV charger network.
Yes, I mean Tesla has its own charger network, so you could say this at the same time it removes a competitor for those networks. But at the same time, if you're buying a Tesla, you want to be able to charge it. You want to be able to have a lot of places to stop. So I don't know if it's a wash when all is said and done. Not sure.
We'll see. Yeah. Stocks lower ahead of the closing bell on Wall Street as consumer sentiment hits 7-month low here, which seems to have overshadowed the monthly jobs report. For more on the latest market moves, let's welcome in now Mike Dixon, Horizon Investments Head of Research and Quantitative Strategies, and Vishal Kanduja, Senior Fixed Income Portfolio Manager at Morgan Stanley. Mike, let's start with you. Listen, U.S. economic data, Mike, was obviously front and center today. Jobs report first, maybe. That investors seem to take in stride, Mike. It didn't really seem to shake up the narrative. You kind of looked under the hood, unemployment rate ticking down, positive revisions. But what did you make of it?
Yeah, it really wasn't, anything but just confirming the trends we've seen. It was, at the headline level, a little weaker than expected, but, revisions were extremely strong. So that more than made up for it. Looking under the hood a little bit, of course, unemployment ticking down, labor force participation ticking up is a good sign. I think probably the highlight for me today was looking at the average hourly earnings. So month over month, you saw that go up about 0.5% compared to estimates, I believe, around 0.3. So that's a good sign. Look, we need the consumer to continue to have and show the strength in spending, and having money in their pockets to do that is exactly what we're looking for to help continue to fuel the economy. But it's that balancing that with the inflation side of things, and I think with some of the inflation survey data this morning as well, the net result is probably just less need for the Fed to cut rates, and as a result, you're seeing bonds down, rates up a little bit.
Yeah, Vishal, I want to bring you in on the rate side of the equation because, yes, rates are up today on, in particular, those inflation expectations as part of the consumer confidence report. But in general, we've seen rates trending lower, even with all of this talk about potential inflationary impacts from tariffs. So talk to me about what's going on there.
Yeah, sure. I think the market got ahead of itself. Probably, if you remember, like the third quarter of last year, where the market had completely priced in probably about 12 cuts by the end of 2025, which we thought was completely not justified at that point, given that the economy was not supposed to be resuscitated from a recession, if you will. But yes, we were coming into it with two very weak unemployment reports. Fed quickly cut 100 basis points, financial conditions eased, you got a Republican sweep, and then the market was overset up for the inauguration day, in our opinion. And that's where you saw that 475, 480 on the 10-year revert back around that 450 level. So we do think that this year is going to be a very range-bound, choppy, very volatile, but the range is going to be 4 to 5%. 4% is going to be difficult to breach for the 10-year because we don't think that the economy warrants or the health of the economy, and we saw it in the employment report today as well. The 3-month, 6-month numbers are back up again pretty nicely. So you got to really squint to find a recession in the economy. And on the 5% side, I think that is where we do think that the economy starts to get a little bit difficult in terms of the refinancing for whether it's regional banks, whether it's commercial real estate property in San Fran, in New York City. And that's why we think it's a very range-bound, but very strong from a bottom-up perspective for the fixed income as well as from an economy perspective.
Mike, bring you back in here. I would imagine if you were Jay Powell, Mike, you saw that jobs report, and it maybe gave you confidence that you made the right move and taking a pause here. If they continue to hold here, though, Mike, and they continue to sit on their hands, what does that mean for the market? How do you think the market would react to that?
Look, I, for one, would not be surprised at all to see, rate cuts continue to kind of come out of the market this year, at least expectations. Although, actually, I think at this point, it's more fair to see the rate cut come out of market expectations, as there really isn't much, in the cards for 2025 as it sits right now. But look, there's plenty of historical analogs for rates at these levels not being a problem at all. As long as we have a strong consumer, growing economy, good earnings, we have all of that. Not to mention, you've got the AI theme, which has potential huge productivity benefits. Of course, we've seen some volatility there recently, and maybe that's been bad for a few names that are priced for perfection. But by and large, cheaper AI is nothing but a productivity enhancer and positive for economic growth. And in that environment, rates at these levels is perfectly fine. So I think as long as we don't get a 10-year over 5%, which seems like a kind of a stretch at this point, we shouldn't really see any stress in equity markets. Just given the underlying economic data and the strength there.
So, Vishal, Mike, they're talking about the interplay as a potential risk to equities if we got the 10-year up again. What do you see as the biggest risk that you're watching in the bond market right now?
I think one of the very clear ones, and I know it is a little bit of a consensusly discussed one, is the deficits. And I think there was a first step towards that when we got the refunding announcement, when we got the new Treasury Secretary speak about the future plans there about issuance and the term premium. I think from our standpoint, and Mike touched on it as well, if consumer and corporate balance sheets are strong, which we have a high conviction in, we don't have to worry about the refinancing wave or refinancing wall that is showing up in some parts of that market. I think we feel pretty confident that will be we'll be able to tide over that. But the treasury market refinancing wave is one that we are definitely nauseous about.
Mike, for viewers right now, we're looking for some ideas and opportunities. You like software and services, you like cloud computing. What don't you like, Mike? What would you avoid?
Right now, one of the things I would definitely avoid is kind of your classical value and classical defensive exposures. When you look kind of in the defensive space, you really need lower rates or really weak growth for that trade to work. I don't really see a strong catalyst for either one of those right now, given current conditions. So I think any allocation that you could have to defensive could be better put elsewhere. And then on the value side of things, while I do think, under the value umbrella, banks are a good place to be. They've been very strong, the deregulatory efforts there and where interest rates should be good for them. But some of the other popular sectors in those segments, like energy and materials, some industrials, these exposures that might be levered a little bit more to China exposure, I think are best to avoid. And, overall, take that capital. And I really like barbell portfolios right now. So still leaning into that software services side of the AI trade, but then also the broadening outside of things with small and mid-cap stocks. I think strategically, as a longer-term hold, this is just a great entry point for that, especially with the range-bound rates, that we're talking about here. Could be quite conducive for that trade to work as we see earnings starting to broaden out, which we have started to see that, here through earnings season.
Mike, Vishal, great to see both you guys, and have a great weekend.
Thank you.
Thanks.
And coming up, we're heading out to the New York Stock Exchange to catch up with the CEO of Titan America as they make their public debut today. Stick around, much more market domination still to come.
Oil prices heading for a third consecutive week of declines. Part of that pressure coming from concerns over a trade war between the U.S. and China. Yahoo Finance's Inez Ferre joining us now for more on the dynamics in the oil market. Hi, Inez.
Hi, Julie. And what a week it has been for oil. Today, we saw prices going up just a little bit. But look, I'm going to show you a 6-day chart here so you can see sort of the volatility, because oil this week is down about 2% overall. You had this volatility starting on Monday when the market wasn't sure about those tariffs against Mexico and Canada. Then you had those off the table or delayed for a month. But still, you saw oil going lower because those Chinese tariffs went into place and China announced its retaliatory tariffs, and then now there's word of perhaps more tariffs that could be announced next week, or a tariff plan. So that is really sending oil lower. Now today, as I mentioned, you saw a little bit of a bump. That's because the U.S. has announced some sanctions against Iran, against some tankers against in Iran, also some individuals. But those sanctions are not so much that they would overshadow this other threat to the oil market, which is really this. The bottom line is that if there is a prolonged tariff war, then you will see prices for oil likely going down. And that's simply because this would slow down GDP growth and it would take demand lower as well, guys.
And Inez, what's the latest with gold as well? The yellow metal having quite the week.
Yeah, well, the yellow metal really going in the opposite direction because, look, year to date, gold is now up 8.5%. It's been touching all-time highs session after session. And this, again, plays to that tariff theme because central banks have been buying record amounts of gold. You have also Westerners going into these physical gold-backed ETFs. That has also driven the price up. But really, it's the tariff uncertainty. Goldman Sachs just put out a note this week saying that is going to keep driving prices higher. And Goldman Sachs has a 3,000 target for gold for 2026, but they're saying there's an upside risk simply because of this uncertainty with tariffs, because these central banks are trying to diversify, trying to also get away from the U.S. dollar, guys.
All right, thank you, Inez. Appreciate it.
Thank you.
Let's get to our call of the day now. That is Robinhood, and that stock moving higher after Mizuho raises its price target on that stock to 65 from 60. Does maintain the outperform, Julie. Here's what they did. They surveyed Robinhood users. They said, listen, would you be interested in using this app for sports betting? Is that something you'd be curious about? And we know that offering is sort of in limbo right now, but their survey showed 2/3 of Hood users already utilize mobile sports betting services like FanDuel, DraftKings, the big kahunas. The vast majority of surveyed Hood users did indicate interest in using Hood for sports betting.
Yeah, and even though he says, it's not a big business, it's not necessarily a big margin booster, but it would be something that would potentially increase engagement with the users on the platform. And as you mentioned, it's in limbo anyway, so we don't know. But that was sort of the impetus for the note. Mm-hmm. But at the same time, Doliv is also updating fourth quarter net revenue because of elevated trading activity, driven in part by crypto and in part by options. So that's sort of the underlying narrative as well.
This stock up 400% over the past 12 months.
Not bad.
Earnings announced, by the way, February 12th. Mark your calendar.
We'll be covering them.
Titan America, the U.S. subsidiary of Belgian cement producer Titan Cement International, began trading at $16 per share earlier today, leaning toward the lower end of the anticipated range of $15 to $18. The pricing gives the company an initial market value of about $2.95 billion. And joining us now from the New York Stock Exchange is Bill Zarkalis, Titan America CEO and President. Bill, it is good to see you. So listen, congrats on the big day, Bill. Walk us through what this does mean for you, for the company, and why go public now, Bill? Why test the public markets at this point? What were the variables that went into your decision?
Well, it's a great time for the market. I mean, we are ahead of explosive growth in the construction market in U.S., and that's why capital from around the globe is flocking here with investment infrastructure, the resilient urbanization, the investment in manufacturing and reshoring, and also Titan America had 10 years of growing ahead of the market. We've grown to become 60% of the group we belong, 60% of the profit, 60% of the revenue. So it makes sense, as we are a pure play in the US, to become a standalone independent US company with our own strong balance sheet and our own independent board to deploy capital behind the exciting opportunities ahead of us.
Bill, talk to us a little bit more about this booming construction business here in the United States, because we've been talking to a lot of economists who have said, you know, because of some of the policy uncertainty around that is out there right now, and also, of course, we've had some projects that were greenlit by the Biden administration now being stopped by the Trump administration, that's creating, at the very least, some confusion about some of these projects. What are you seeing in your business?
We see that the medium to long term are trends are extremely strong. We feel that the trends, there are secular trends. The demographics, also the household formation supports strong build up in the construction industry, especially in the residential, but also the infrastructure. Especially the deregulation that this administration is going to bring is going to shorten the time between planning a project and executing a project, breaking ground, and we feel that this is going to accelerate the growth.
You do operate, Bill, in a competitive market. I'm curious, what makes you different? What is your competitive advantage?
We have very strong positions. We have a proven business model that, and we grow faster than the market. We have strong positions. We have differentiating pipeline of products with ultra high performance and also with very low carbon profile. Overall, we have positions that allow us to take advantage of the explosive growth ahead of us in economic mega regions that are growing faster than the average of the United States.
And Bill, tell me, where do you all manufacture for the products that you're selling in the U.S., and where do you get your feedstocks from for the products that you're making? I'm asking, of course, because of the potential for tariffs, not just talking Canada and Mexico, but maybe the EU as well.
We produce in the majority of our projects, obviously, in our country. We produce in Virginia, in North Carolina, in South Carolina, in Florida, and we have a terminal in New York and New Jersey, and we have strong positions through that. We complement our products and that we sell with imports, but our imports are either in the EU, and also we have developed alternative imports from other countries, so we don't expect the tariffs to affect us.
Bill, you touched on this, but I'm just curious to hear a bit more. You know, Trump is back in office, and as you noted there is this bet that that's going to be a more pro-business regulatory backdrop, regulatory environment. Walk us through what you think the possible implications of that are for your company, your market.
Overall, we think that the regulation is going to help accelerate the growth that we expect, especially with the $1.2 trillion in infrastructure investments. Overall, we're very positive about what we expect ahead.
Bill, thanks so much for your time, and again, congratulations.
Thank you so much. Thank you for having me. I appreciate it.
Well, from tariff talk to big tech earnings rounded out by today's jobs data, it's been a wild week here at Yahoo Finance. Here's a look back at what you may have missed over the past few days.
We started the morning with 25% tariffs potentially on both of our neighbors here. By mid-morning, Mexico received a 1-month reprieve.
So this would have been extremely costly. It would have made U.S. industry much less competitive against the rest of the world.
That will help him down the line when he inevitably negotiates with the Europeans and, of course, the Chinese.
We're doing a nice job of eliminating unnecessary costs and at the same time investing back in the business.
We're really pleased with the 26% growth we saw in 24.
We believe that we are executing really well in our restaurants, and we're really proud of these results.
143,000 jobs added during the month of January.
We are looking for a trend around 200. That's right in line with what we would expect.
This doesn't incentivize the Fed to do anything right now.
We're settling into something like full employment.
Despite delaying tariffs on Mexico and Canada, President Trump is ready to announce reciprocal tariffs on many countries. Washington correspondent Ben Werschel joins us now with more. Trump making his latest comments today about more tariffs. Ben, what can you tell us?
Yeah, so this is the latest from Trump, and it's a sort of multifaceted approach to trade at this point. What he announced today is that next week, probably Monday or Tuesday, he's going to have meetings and then make an announcement, probably in a press conference, about reciprocal tariffs. This is something Trump has long talked about, basically a kind of literal tit for tat tariffs, where if a foreign country has duties at a certain level, the U.S. imposes the same duties. He's talked about doing it unilaterally. He's also talked about having Congress even get involved and making this perhaps even more automatic. I think the big question for the moment is sort of how this fits in with everything else. This comes also after a week, obviously, where 10% blanket duties came in on China. We also had the U.S. Trade Representative on Capitol Hill outlining plans to at least study a universal tariff on everyone. And then there's a 30-day delay on tariffs on Canada and Mexico, which according to Trump are still very much alive. So it's all kind of in this mix, and we'll have a little more clarity on Monday exactly how reciprocal fits into everything else.
Yes, and we'll probably get a drip of stuff over the weekend as well, Ben. Fun times. Thank you so much for the details. Appreciate it. Well, despite today's jobs report coming in a little lower than estimates, most economists believe the labor market does remain relatively solid. However, there are a few factors that could change that equation, and here to help us outline some of them is Guy Berger, Burning Glass Institute Director of Economic Research. It is great to see you, Guy, and I really appreciate you joining us. So I guess there are a number of different categories we can look at that we should be watching going forward to potentially create some noise in the jobs report. And I want to start with what is going on the government level, actually, and the efforts of DOGE. Now, when you look at the government additions to January's employment report, you saw 32,000 jobs added. What is all of this, the potential buyouts, the cuts? What effect is that going to have on job growth and potentially economic growth eventually?
Well, it depends on how much happens and over what time span. And I think it's a giant question mark. I mean, if this turns out to be a situation where essentially a lot of government workers relatively quickly find themselves out of job, and we're saying a lot, I'm talking about numbers in the hundreds of thousands or heaven forbid, millions. And then on top of that, we're also talking about potentially cutting back money that supports all sorts of private sector jobs that the government's funding. Then this could have a pretty big dent on economic growth, on the employment data, especially if it happens quickly. And I think the big question mark is this going to happen at what scale, or is this a bunch of cosmetic targeted things that are relatively small ball and don't make a difference at all? I think it's very uncertain at this point how far this is going to go and how many people it's going to impact. But it could be material if it happens quickly on a big scale.
I'm just curious, Guy, because you've been doing this for a while. How difficult is it for you to actually make forecasts right now? It's obviously always very challenging. You're always, as an economist, you're balancing all kinds of variables. But right now, I mean, we were just talking about DOGE. Maybe there'll be spending cuts, maybe not. If you were on just a few days ago, Guy, there were massive tariffs, but then maybe not. I mean, is it more difficult than usual for you as an economist to try to forecast this?
Yeah, it is, because we're talking about big changes, which may or may not happen, may happen at different times. We don't know when, and some of them are offsetting the effects of the other ones. I think, you can talk about how difficult it is for me, but when we listened to Chair Powell last week, that was a lot of it. Is he says, we can do our forecasts, but he didn't say who knows, but I think that the subtext was, until I know what's actually going to happen, it's very hard to predict what we're going to do and how we're going to react to it.
Well, Guy, I'm going to ask you about a couple other variables that are tough to predict right now. One of them has to do with another effort by the new administration to deport illegal immigrants. As you know, immigration has been a huge factor in the job growth that we have seen. So what are you watching? If you don't yet know what's going to happen, what are you watching that will help inform, your forecast and let you know what's happening?
Yeah, I think the first thing is, I think it's, there's so much focus on flows across the borders, particularly the southern borders, which, by the way, have slowed substantially in the past 6 months and may already be starting to filter into lower employment growth. But beyond that, I mean, honestly, I'm looking at visas and how many of those are being issued. They were running at fairly high levels during the last administration, where there's efforts to reduce that. We will see. I know it's been a hotly debated topic. I don't know what's going to be implemented here. I think the way I would think about it is there's two things. Even without deportations on a large scale, just the fact that we're letting fewer people in is going to slow monthly employment growth, probably slower economic growth, but may actually not have much impact on how tight the labor market is. There are going to be fewer people coming into the economy looking for jobs, and it might be able to have, that essentially are looking for a job, things get easier, the job market gets tighter as labor market gets more scarce. And then on top of that, we were talking about the layoffs potentially and buyouts coming to the federal government. If we do see deportations, on what scale do they happen? How quickly do they occur? It could be one of those things that happens at a fairly gradual pace and essentially, causes some dislocations, but not on a large scale. It could be that disrupts a bunch of sectors all at once, and employers are suddenly scrambling desperately to find people to do the jobs they rely on, foreign-born residents to do. And I guess I have huge question marks, but I am pretty confident that this big wave of immigration we saw is not going to be repeated over the next 4 years, even if there are no big deportations, just because fewer people are going to be coming in.
Let me ask you guys about inflation, because it was interesting that in that jobs report we got this morning, there was that hotter wage number. And then, of course, Guy, you saw that the sentiment data we got, which I think threw people for a loop. That was a big headline. You add that up, the trajectory of inflation looks like what to you next 6-12 months?
Well, so I always caveat this with the fact that I'm a labor market expert and inflation dilettante. But listen, my opinion is, if the labor market stops, I don't think the labor market has played a big role in driving inflation, so driven by other stuff. But if the labor market heats right back up because we're making decisions that constrict the supply side via the labor market, maybe through tariffs too, and then on the flip side, we have big tax cuts that essentially boost demand and, in terms of people's spending power. That pushes the meter a little bit toward more, not less inflation. I think it depends. If you lay off a bunch of government workers and do nothing else, that actually reduces inflationary pressure. I think that's sort of the giant question mark, is your uncertainty over inflation, which is already pretty high based on the experience of the last few years, should be even higher over the next year or two than it has been. But if I had to guess, I think the balance of policies that seem most likely to happen are probably a little bit more on the inflationary side and less on the disinflationary side.
So, Guy, let's get back to something else that could change, if not harm, the broader job market. Another factor that doesn't really have as much to do with policy, and that is the rise of AI. There's been a lot of debate about what kind of effects we could potentially see. We have seen anecdotally some firms, at the very least, redeploying, laying off some folks, hiring AI sales force, for example. How are you thinking about that issue?
Yeah, so first, we have this wonderful census survey, this amazing government data that we have that we're so fortunate to have because of our government statisticians that collect every 2 weeks, ask U.S. companies a lot of things, including, have you used AI recently? Are you planning to use it? And we've seen that creep up. There tends to be heavier adoption among bigger firms than among smaller ones. We are seeing adoption go up. I'm guessing that a lot of it right now is workers automating certain tasks. In some cases, it really does impact certain jobs specifically that AI can do very well. But, the technology still has limitations. I think it's a story that's going to play over a long time. Do I think this is significantly across the span of the economy reducing employment right now? No, not at all. And it could be a long time. And there are going to be new jobs that are created probably because the technology creates new opportunities for people to do things that didn't previously exist, a lot of which are not going to be tech jobs.
So so that's an interesting idea. Where would those jobs be? Because I was going to ask you what sectors you think might be most affected.
Well, if you think about sectors that are most affected, I think information services is where it is. And I think that's where adoption's been the highest. And that includes, by the way, not just tech. Tech firms are already using this technology pretty heavily, but also traditional media. You have more, this is debated how much people like this or not, but, a lot more writing is now done by AI or supplemented by AI. It's being used in that kind of sector. So I think those are where things are being felt. And the question is, does technology's capabilities and adoption expand to other areas? Are there other, what we always think about as like routine or repetitive knowledge work, or a place where you have hired an intern that you're going to use this technology? And I think this is going to be gradual as people experiment, but it is happening and becoming more widespread, at least in a shallow fashion, as we speak.
Guy, great to see you. Great to have you on the program today. Thanks for joining us.
Thank you.
While wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including a conversation with ARK Invest CEO and CIO Cathie Wood to discuss her big ideas for the year. You won't want to miss that conversation. Stay tuned for Market Domination Overtime.
Closing bell on Wall Street, and now it is Market Domination Overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. I want to start with the major averages, all of them closing kind of near the lows of the session here. The Dow off a full percent, off about 444 points. The S&P 500 down nearly 1%, and the Nasdaq Composite down 1.4%. Now, a couple of cross currents in the market today, things for investors to consider. We, of course, had this morning's jobs report showing a lower than expected gain in jobs in the month of January, but the unemployment rate falling to 4%. 4.1% was expected. And then, of course, we had a sort of surprise confidence report coming out at 10 a.m. showing the lowest confidence that we've seen in 7 months and a big uptick in inflation expectations. Add to that some new tariff headlines back and forth over the course of the day, with President Trump saying we could get some more reciprocal tariff announcements last week, all of that equaling a bit of pressure on the market today. Jared's going to drill down into what we saw. Jared?
Well, thank you, Julie. This reminds me of about what I'm about to say right now. Reminds me of what I was saying Monday, which it could have been worse. And we've had a lot of tariff news this week. And I will show you the 5-day here. If we have the Wi-Fi interactive, we're down 0.5% on the Nasdaq. In the Dow, we're off 0.5%, just a tiny bit more, 1 more basis point. And the S&P 500 down 1/4 point. Let's put the small caps in there. That was down 1/3%. So really not looking at like too much damage right now. And you can see in the 10-year yields are up just a little bit today versus yesterday, up about 5 basis points, not quite to 4.50%, and definitely off of the highs that we saw earlier in the year. Those are the January highs that we're looking at right there. US dollar index just a little bit higher today. So really not a lot of damage done with what I consider a pretty hot payrolls report. Not in the payrolls number itself, but those wage gains pretty strong. But nevertheless, you're seeing some damage here done today to the mega caps. Amazon down 4%, Alphabet down 3%, Tesla down 3%, Apple 2%, and Microsoft 1%. Meta, though, this is Meta's 15th day, and I'm going to put a 1-month chart. Almost all of this has happened within the last few weeks, and I think 11 or 12 of those have been at record highs consecutively. That's just something you really haven't seen in this issue, or maybe any other. That'd be an interesting case study to look at. Nvidia also looking at gains of 0.9%, and just looking at the leaders here, Chinese internet stocks kind of came back today. China's on my radar. Going to be talking about that with Josh in about 30 minutes, and I will leave things on the Dow. So a lot more red than green. Nvidia, bright spot again, but also Coca-Cola, Staples perking up, Chevron, Cisco, and Visa among the names in the green. Some of them just barely. Guys?
Jared, thanks. Tesla CEO Elon Musk's role in the Trump administration has grown rapidly since the inception of the Department of Government Efficiency. But with Tesla shares having one of the worst weeks since the election, investors are wondering if Musk's role in DOGE is pulling him away from Tesla. For more, we're bringing in Cathie Wood, CEO and CIO of ARK Invest. Cathie, always great to see you. Tesla is still your top holding in your ARK Invest, ARK-K, as we like to call it. That's the ticker. And you know, we've got, obviously, Musk very visible in Washington. But not only that, Time Magazine put him on the cover behind Trump's desk as the sort of de facto president, if you will. Now, we have talked before, Cathie, about Musk's multitasking. But this is sort of next level, Cathie, in terms of where he is putting his attention. Is it a concern for you as an investor?
Well, it's interesting. We were on his earnings call last week, and I don't think I've ever heard him more engaged or more into the details, answering in detail analyst questions. So as I've said before, I think he's an amazing CEO in that he is a troubleshooter. He figures out where the pinch points are, the gating factors, and he goes right at them. And I think he's doing it very effectively.
I mean, at the same time, the stock has taken a big hit. I mean, he may be figuring out those points, but at the same time, we got a lot of reports recently about Tesla sales, being down, deliveries being down in places like China and Germany.
Yeah, what's happening is the Model Y, which is the largest selling car in the world, is going through a refresh cycle. And I can tell you personally, I went to buy a Model Y, and at the showroom, they said, no, wait, the whole thing's going to be refreshed. This was several months ago, and lo and behold, this is where we are. So I'm happy they told me that, and I think I understand why we're seeing sales lag here a bit.
So what turns it around, Cathie? What's the catalyst that moves this stock higher?
Yes, a couple of things. I think they're going to come out with their lower cost car this year. So that will increase access to Tesla's cars. Elon's always talking about affordability, certainly working on that one. And then, of course, autonomous. We do think that Tesla is getting ready to launch its autonomous service. We know they will launch. They announced the launch in June in Austin. And the question then is how quickly will they roll out to other cities? And we think it will be more quickly than many think.
Another headline that we saw today is that the Trump administration, as predicted or as expected perhaps, is halting the government's $5 billion program to build out a national charging network. Is that a wash for Tesla? Is that a negative for Tesla if people don't have as many places to charge? Does it benefit Tesla because they're building their own network? How do you view that?
Yeah, I think, well, a lot of auto companies have already signed on to Tesla's standard. And so why not use the the Tesla charging network instead of duplicating expenses with government subsidies on top of that? So I think it will benefit Tesla. I think it will be good for the entire ecosystem.
Cathie, we're making our way through earnings season, that mega AI trade and trend, Cathie. Some names reporting perhaps some disappointment. I'm curious what you've learned this earnings season, looking at those reports, listening to conference calls. Has it changed at all how you want to invest, where you want to put money to work in that AI trade?
Well, as we know, Palantir has been a huge beneficiary of this earnings season. I think many people are beginning to understand that hardware important, but in order to deserve the valuations they're getting, there have to be beneficiaries beyond that. And we think platform as a service is going to take increasing share of the tech stack. And so that does benefit companies like Palantir, GitLab, and others that developers are signing on to.
I'm curious though, Cathie, why, yes, those companies will benefit. I'm curious why you're not in the hyperscalers. So, we've talked before about you not being in Nvidia. I'm curious why you all have made the choice to go the route that you have with Palantir and the other names you mentioned versus some of the other Magnificent Seven, for example.
I think we are in all of them in various of our portfolios. You're asking about ARKK, the flagship. We do own Amazon. And we do think, after listening to the call last night especially, the cloud is a central part of this story. So love what they're doing there. We were concerned for some time that maybe agentic personal agents we're going to disintermediate Amazon on the retail front as our personal agents go shopping around the web for us. But, I do believe that Amazon's got, they said last night, a 14% advantage in terms of lower prices vis-a-vis other online shopping sites on average. So we're less worried about that. And as you know, we post our holdings and trades at the end of every day. So we have been building that one. Nvidia, we do own in other portfolios. We think there is huge demand going forward. But again, just listening to Amazon's call last night and to others, there's more competition brewing on the chip side of the equation. Amazon has two, Graviton and Trainium and Inferentia. So on the supply side, there is more competition brewing. And we are also seeing with DeepSeek, for example, there is a possibility that more of the large language models are going to be built on high-end workstations, maybe not so much dependent on the cloud. High-end workstations depend on fewer GPUs. All of that said, this is all at the margin. The whole space, we think, is going to be vibrant for years. We are so early in the journey here, and we're pretty excited about it.
On Amazon, though, Cathie, the stock did come under pressure today because AWS sales showed no acceleration. So as a believer, as a shareholder, as a bull, is your bet there, listen, those capacity constraints they're going to ease and the AI rollout is simply, we're early days still?
Yes, we do believe that the capacity constraints will ease. Amazon said second half of this year. So yes, we do.
How close do you think we are to that agentic AI future that you were just talking about, where, you know, I have an agent and I tell it to go buy me something and it just goes and searches the web for that thing?
We think it's going to be here sooner rather than later. In terms of agentic right now, we're seeing coders, for example. Well, AI, large language models, you can give them a coding project, and we're seeing that they can accomplish 85% of the task with no human intervention. That's the beginning of agentic, and we think it's going to push into every sector very quickly. You know, AI training costs are dropping 75% per year. AI inference costs, which is what would be used for this personal shopping agent, they're dropping 85 to 95% per year. So the cost of innovation is collapsing, and we think more innovation is going to happen, especially around this agentic AI opportunity.
Cathie, you know, as I always do ahead of us talking, I go and I look at how the various ETFs have been doing, not just ARKK, but the others as well. And I know you like to be judged on a longer time horizon. So I'm looking at 3 years, I'm looking at 5 years, I even looked at 10 years. On all of those metrics, especially the benchmark ETF is lagging the S&P 500. We've talked about this before. What do you tell investors, clients, when they come to you and they say, Cathie, what's going on here? When am I going to be getting these big returns that should be coming from these big innovation plays?
Well, we have just come from facing 3 major headwinds over the last few years that have turned into tailwinds. But before I mention those, I should say over the last 10 years, Morningstar has, who ranks all ETFs, we are in the top, I think we're in the top 7.5% of their rankings in terms of where they classify us, which is in mid-cap growth, because we do tend to be smaller cap than the broad-based benchmarks. So over a 10-year period, top 10%, we'll take that. That said, these 3 headwinds, what were they? And they really started after COVID. First was the concentration in the markets towards the Mag 6. I think after the fallout from COVID and the sorting out of the market, you know, people have been scared and saying, you know, they value cash very highly as interest rates went up, and they like to dabble in the larger cap. That's the safer part of the market. So that the broadening out of the market that we are expecting now should really benefit us. So the first headwind was concentration in the markets. The market is beginning to broaden out. We see that since the election. The second headwind, I mentioned it, was interest rates. We went through a shocking increase in interest rates, up 24-fold in little more than a year's time. All long duration assets were plastered by that, including bonds that are supposed to be the safest asset class. They had some of their worst years in history. So concentration, interest rates, and then the last headwind we faced, especially in early 21, as the COVID had bid up our kind of stock to, you know, incredible heights from a valuation point of view. We had to work or grow into that valuation. And in the yen carry trade period last year, so last July, August, what we saw our portfolios based on an adjusted enterprise value to EBITDA ratio drop towards a market multiple. We've worked with S&P to develop this index. So the valuation headwind is gone as well. So concentration, interest rates, valuation have turned from headwinds into tailwinds.
Cathie, always good to see you. We covered a lot of ground in a short amount of time. Appreciate it.
Thank you so much.
Big tech is doubling down on AI spending. Amazon, Meta, and Alphabet among the big tech names ready to shell out billions in capital expenditures this year, with infrastructure a key building piece to support AI demand. We're taking a look at how this shakes out in the options market. Kineo Capital Managing Partner Jim Struger joins us now to discuss in the options playbook, sponsored by Tasty Trade. Good to see you, sir.
Thank you. Thanks for having me in.
So you point out a big theme in 25 is actually one, it was a big theme in 24 as well, AI, right?
Sure.
How do you sort of see it evolving, playing out, Jim?
Well, you mentioned Amazon down today. One of the reasons it's down is people are probably a little unhappy with the surprise uptick in CapEx, but there are a lot of companies that are going to benefit from that. So you mentioned the hyperscalers, Amazon, Google, Meta. They're going to spend about $240 billion in CapEx next year. A large amount of that is going into AI infrastructure. Obviously, you need power to drive those data centers. So as much as your previous guest talked about this, it's a big theme for us. We manage AI infrastructure strategy because we believe that this is not just a 2 or 3 year phenomena, not just for AI, but electrification, onshoring, tariffs, whether threatened or real, are going to trigger US-based companies to build infrastructure in the US. So all of these factors are going to play out a long course of time. If you follow nuclear, for example, today, the market gets it. As much as there was another tweet to take down markets intraday, there are components of this market that are responding a little more positively. And the real duration here, we think, is because a lot of this on the power side will take 5, 10, 15 years to build out.
Well, before we get to how you're structuring the options trade, I want to ask you, about the upside we've already seen. Some of the errors come out of some of these plays.
Sure.
But like last year, it was amazing to see utility companies, these electrification plays, infrastructure companies that are usually pretty boring, for lack of a better word, soar as much as the AI plays. So at a certain point, when do they get too expensive?
Well, I don't think it's anytime soon, frankly. As you just said, if you think about utilities, I've been around for a long time. It's always been about the long end of the yield curve. Yields are lower and utilities are more attractive. We think that game's over, and we think the transition now is appreciating not just utilities, independent power producers, a lot of power energy related companies. It's going to be more about scarcity going forward than necessarily about staring at the 10-year and judging whether or not you want to be in utilities. For example, think about pipeline, right? Natural gas is going to have to play a key role in this transition to increasing power capacity in this country. We're walking right into a big deficit. No one's going to run around and relay pipe all over this country, yet you have underloved assets that have been there, and with it, relatively underloved companies for many, many years. And we think that investors take a real hard look at some of these assets. You can look, for example, at nuclear power. There are companies out there that have, say, a gigawatt of nuclear power. The whole company is worth half of what it takes to build a nuclear power plant from scratch. So there are a lot of data points out there that say, there's really dislocation evaluation. Does it happen next week? Does it happen over the next month or so? Or does it happen over the next 5 to 10 years? It's going to play out over the longer course of time. But we think there are really significant dislocations in valuation, exactly as you described. They used to be underloved or unloved, and now they're really coming to the fore for investors.
Let's talk about one name in particular, Vertiv, ticker VRT. Why is that one on your radar?
This is on our radar because if you want to have exposure to the build out of data centers, we just said $240 billion plus Stargate that President Trump announced with Oracle and SoftBank and OpenAI, that's another $500 billion potentially in data centers. And a company like VRT, which has its origins from back to the 1940s in Columbus, Ohio, in refrigeration, they were one of the first companies to bring AC into computer rooms back in the 60s into the 70s. So they supply a lot of components. Some of the most important is cooling technology. So thermal technology, data centers, servers get very hot. You can look at diffusion cooling now, or immersion cooling now, where you literally dunk the servers into engineered fluid to cool it down. Vertiv offers these sorts of products. So many, many products that they sell into the data center. Post DeepSeek, stock was down 40%. It's recovered about half of that. They report earnings next Wednesday. Every quarter last year, they took guidance higher for revenue. So for us, we think this is just a core name for everyone to own, especially if you're thinking, how do I get some of this CapEx from the hyperscalers into my portfolio?
All right, bring it home for us, Jim. You got two option strategies to play Vertiv.
Sure.
Tell us what they are.
So first of all, implied volatility elevated, right? Not just from the DeepSeek, but you have earnings next week, so it lifted and it stayed up there. So we want to try and take advantage of that a little bit. The first trade assumes an investor is already long stock. And what we want to do here is just go out and overwrite it. We'll break it down so hopefully it makes some sense. Go out to regular March expiration, sell 155 strike call against your notional holding of the underlying, right? You bring in that capital, and then you're going to turn around and in that same March expiration, put on a 145, 155 call spread. What does this do? You're not putting up any additional capital because you're taking in premium from selling that 155 strike call, and then you're buying that call spread. So instead of a linear payoff over the timed expiration in March, you're creating convexity to the upside, right? Which is what we want to do. We think earnings come next week. We think they reiterate guidance. We think there's a positive, even if, if not Palantir-esque response. We don't even need that. We just want a solid report, let it walk higher, and we can create that kind of convexity again without putting up any additional premium.
Okay, do we want to do the last one? Do we have time for the last one, guys? Oh, we gotta leave it there.
Okay, that's fine.
Okay,
Next time.
we'll save it for next time.
Palantir-esque. Leave it
I
at
know,
that.
I like that as
Leave it at
a new adjective. Jim, it's always good to see you.
Nice to see you.
Oh, thank you so much for coming in. Appreciate it. Coming up, we'll hear from the CEO of Affirm, Max Levchin, following the company's latest earnings report. Stick around, more market domination overtime still to come.
Affirm shares flying high as the company tops earnings estimates, posting a surprise profit. Firm citing general merchandise and consumer electronics categories contributing significantly to the growth. The buy now, pay later provider also highlighting it is in the strongest shape it's ever been. And joining us now is Affirm founder and CEO Max Levchin. Max, it is good to see you. So you report investors clearly like what they see, Max. Your stock rips more than 20% in today's trade. Walk us through the quarter, Max.
Palantir-esque, is that what you guys just presented on air? I can only aspire. Great quarter. There's nothing to apologize for, as they say. Saw really strong demand in a whole bunch of categories. For no surprise, travel remains really strong. We're still seeing 4-handle growth now, and just anticipation of Super Bowl, et cetera. Electronics have done really well, all across. And the real reason for why we did so well is consumer preference. Folks are choosing Affirm at the point of sale because we have built a better mousetrap. It's a better product, and it's finally clear, not just to consumers, but also, I think, to the shareholders. But it's certainly done well for a lot of people this holiday season.
And Max, I'm curious, we have been trying to sort of read the tea leaves on how the U.S. economy is doing and how it is going to do, given a lot of headlines that are flying around. We saw that reflected in consumers' inflation expectations today. I'm wondering if you are seeing this in evidence anywhere in the spending patterns that you're tracking through Affirm. If there are any areas where people are looking for value or where they are spending less right now.
Generally speaking, U.S. consumer is healthy. There is not a problem with the U.S. consumer. There are definitely real winners and losers in the merchant ecosystem. Consumers are choosy. They look for folks that give them great deals. We saw massive growth of 0% APR transactions, which is where the merchant subsidizes the cost of borrowing. And so there are absolutely people looking for a reason to say yes and to buy, but folks are shopping, they're borrowing, and they're paying us back. You saw our delinquency numbers are below last quarter's and in line with our expectations, better than in line. And so the U.S. economy is on solid footing. And on the one hand, inflation obviously is not a great thing. On the other, as far as Affirm's business is concerned, when things become a little bit too expensive to afford in a single purchase, we're there to help. We are literally the antidote of inflation. And so in some ways, we see a little bit more demand if inflation expectations go up a little.
Max, I got to ask you, when you see results like this, are you taking share, Max? And if so, who are you taking share from?
Everyone last quarter, if I'm allowed a moment to brag, we know from public data, we outgrew our nearest North American competitor by 10 points, globally by 20. We've increased our numbers within e-commerce. So we're taking share from credit cards, which we were founded as the antidote to revolving credit. And it seems to be resonating with consumers really strongly. And offline, we're there to compete with credit cards, but we're also there to compete with cash. And fundamentally, digital payments, the entire industry exists to replace cash. And so more than anything, I think that's the loser and good riddance. But we were kind of the winners all around.
Max, I think we've talked about this before, but I'm curious to get your view now on, obviously credit cards are still huge, right? But I'm curious, 5 years from now, 10 years from now, how you think that balance looks between buy now, pay later, or sort of the debit ecosystem versus the credit card system?
It's a great question, and I wish I had a crystal ball to tell you exactly what those numbers look like. We know that in economies where credit cards are not as deeply held by the consumers, buy now, pay later in one form or another grew all the way up to high 20s. And so we think we're very far. For comparison, we are in a single digit of US e-commerce. We just launched in Europe, and so we have a lot to grow there. So there's plenty of TAM to go. That's definitely true. What I really am curious about, and we're doing things to bring that future along, I think majority of US debit cards and maybe worldwide debit cards will have a buy now, pay later feature built into them. I think the world of credit cards are the only way of paying over time is coming to an end, and debit cards will gain the rightful share.
Max, I want to ask you about the mega trend of AI. Investors are obviously very excited about that trend. Of course, the job for investors, try to distinguish between what's real, what's meaningful, and marketing fluff, Max. I am interested. Affirm, how are you all leveraging that technology now and ahead?
I greatly appreciate the interest in actual AI use versus the marketing kind. we are an AI company through and through from inception. We don't love to throw around the terms, especially as it became more popular. We pretty much stopped talking about it. But our underwriting is entirely machine driven. You wouldn't be able to underwrite millions and millions of transactions per week unless you're fully automated it. And machine learning and AI indeed is what powers that. In the sort of more recent, chat style AI, we use that extensively in our customer support. We always allow you to escalate to a human, but 2/3 of our inbound customer service queries are handled by a chatbot that connects to our database and our knowledge base and helps folks navigate whatever ails them in the moment. And then internally, sort of even less obviously, where not where it meets the eye, we use all sorts of really, really cool cutting edge AI models to figure out everything from fraud to abuse of the system. Also things like merchant marketing, we observe and react to misuse of the Affirm name or misrepresentation of what Affirm will and will not finance. So we use AI in all kinds of different ways. We don't sell AI. We don't really have a massive CapEx earmarked for AI at all. We are buyers of tools by others and primarily builders of our own tools, which allows us to control the costs.
And Max, just a quick follow on this. I mean, I just was looking at a number that you guys have around 2,000 employees. Is that correct?
That's right.
So that doesn't seem like a lot of people for the size of a company like Affirm. And is that because of what you're talking about? And do you expect that headcount to sort of be fairly stable even as you grow? Or do you expect to hire more folks?
That's right. And if you actually look at our headcount historically, we've kept it basically flat for the last year or two because we've been able to find operating leverage by deploying more and more software tools. It doesn't just have to be AI. The company was founded by 4 computer scientists, and we've stayed true to the idea of it's better to build software and solve the problem with machines than by hiring more people, and we'll definitely continue to approach the world that way.
Max, finally, if you'll permit us, I want to ask about your old colleague, Elon Musk, and what he's currently doing now. You guys, of course, co-founded PayPal, and built that into an amazing company, but you had your ups and downs, I've read, over the years. What do you make of what's currently happening with DOGE and what he's doing to government, given your own experience with him?
We're friends, yet he's got a bunch of things he's working on. He's a busy man. We don't spend a lot of time talking, but fundamentally, the idea of bringing this fresh breath of entrepreneurial energy to the government, to my mind, is kind of long overdue. U.S. was this great startup of a country a couple of 100 years ago, and a lot of what makes us so great is the spirit of innovation, willingness to take risks and willingness to break glass and come up with new ideas. And the idea that government is bloated and has bureaucracies to contend with is not exactly novel. We all know, the trip to the DMV or, many examples come to mind. And so the fact that there's an effort in DC now to look for inefficiencies and dismantle them, I can't exactly think that it's such a bad idea at all. So I support the notion of making the government more efficient for sure.
Sometimes it feels like the dismantling is coming before the actual looking for inefficiencies, but we'll see how it works out over time.
I think we'll definitely see.
Yes, we will. Max, thank you very much. Really appreciate it.
Thank you for having me.
That'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Ask for a Trend. Stay tuned. We've been hearing from all the big cloud players on earnings calls, and investors are disappointed with the results. Amazon, the latest with Amazon Web Services revenue coming in light for the fourth quarter. For more, we're bringing in Ben Beharin, CEO and Principal Analyst at Creative Strategies. Ben, always great to have you on the show. So we have heard, Ben, from the big cloud giants, Amazon, Alphabet, Microsoft, and there did seem to be some disappointment, Ben. You look at Amazon, AWS sales showed no acceleration there. It seemed to echo the results we saw from Microsoft and Google Clouds. What is going on there, Ben?
Yeah, I think there's a couple dynamics that we can interpret from this. I think we get lost with this idea that, a lot of this increased spend in the cloud is coming from AI, and there's part of that, which I'll get to in a second. But I think we forget that there's a lot of general purpose cloud that is still out there. And I think we saw a lot of strength in that spending. That's just, again, enterprises needing to bring their workflows from the cloud. Most estimates have that most large enterprises have 40% or less of their workflows on the cloud. So there's still a long on-ramp of just getting traditional enterprises to move basic workflows, again, we'll say general purpose workflows, to the cloud. And then you have the AI side of this. And I think where we saw a lot of the growth in that spending was, we know many organizations are out there training and deploying and doing these pilot projects for AI across their enterprise, but they're deploying those to a small fraction of their enterprise while they're doing these pilots. So we haven't seen that spend happen yet, and I think we're seeing a little bit of a pause of that, which is the result of we as an enterprise or the market segment has gone and done those pilots, and now they're waiting to mass deploy, and we think that's what's going to happen in the second half of this year.
So your bottom line, Ben, what you're arguing is the AI cloud rollout is still early, and you're betting on better prospects ahead second half of 25?
Yeah, and I think that's, again, just predicated on, all of these organizations who are doing these AI projects, whether that's in customer service or whether that's in automating a whole slew of their broad tasks from marketing to finance, engineering. That's not deployed to 100% of the enterprise. In fact, it's probably 10% on less on average. So we're waiting for that ramp. And I think that spending happens in the second half of this year. I think that's what most CIO, CTO surveys are suggesting, is that's when that money will deploy. So we're kind of in this little bit of a gap, like I said, where we're still in project phase, piloting phase. We haven't moved to deployment, and we're not seeing that scale yet like I think we will in the second half.
It was interesting, man, because when you listen to these big cloud giants, they talked about capacity constraints. So I guess that suggests, listen, we're just having a hard time getting our hands on enough data centers, hardware, chips, networking gear. What does that tell you about potentially big tech CapEx plans for the rest of this year and maybe into 26?
Yeah, I mean, I think you continue to see them commit to larger CapEx spending. I think, an interesting analysis is just look at how historically Amazon in particular, but you can tie some of this to sales, how the hyperscalers have actually seen direct correlation to CapEx spends to an increase in sales, increases in revenue. That's been a correlator for Amazon for almost 10 years now. So I think we'll continue to see that. They're justifying that CapEx spend. We still anticipate that they'll continue to spend that because, again, we are still selling a small percent of AI servers, whatever we want to classify in the AI server infrastructure as a part of the general purpose spend. There's still a massive amount of data center infrastructure that's got to get converted into new AI infrastructure. And again, that doesn't take away from the fact that we're still selling and shipping general purpose servers. This is additive. This doesn't take away from those general purpose services. So there's a long ramp of growth here. I think we'll remain compute constrained, and that's what the race is on for. And when you hear really all the CEOs of these companies, they're saying, right, this is a once in a lifetime opportunity. We need to spend so that we get the portion of this market share. They know they're competing for that, and they're going to be at a shortage of infrastructure, which, if anything, should continue to convince us all that there's still a long roadmap of silicon and infrastructure spend, despite the negativity that the market sees there.
So is one read through, Ben, is what you're suggesting there, if I'm a viewer right now and I'm invested in Nvidia, do I have a smile on my face?
Yeah, I mean, I think, again, they're well positioned. They're still going to be the primary beneficiary of the vast majority of this CapEx spend. You have people out there thinking they could double revenue this year. I'm not that optimistic. I think they'll do better, right, than 2024. But there again, we're going to remain compute constrained because AI innovation, and you see this, like DeepSeek again, didn't do anything to change the thesis that scaling laws still exist and will demand more compute, not less, as we bring inference costs down. And AI is outpacing our hardware compute, and that's not going to change. In fact, we probably have a long, many-year roadmap where the pace of AI software will outstrip compute. So this is a long growth cycle. I think there's a lot of technical nuances to this that just get misunderstood, which is why I think the market does what it was. But the demand is not slowing. Compute needs are going up, and that's not changing anytime soon.
Ben, always great to see you. Always great to have you on the show. Thanks for joining us.
Yep. Thanks for having me, Josh. Have a good one.
U.S. stocks closing lower as investors react to tariff and inflation fears. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Josh, we had kind of a negative week in the majors, plus the Russell 2000. I want to focus on the mega caps here, and specifically the Mag 7. So my first headline here is the Mag 7 is split. I'm going to take us over to our mega caps. I got the Mag 7, and I even threw Berkshire Hathaway in there because I think it unfairly gets left out. It's $1 trillion company, so it makes the list here. This is the year-to-date totals, and Josh, you're going to see there's more red than green here. Mm-hmm. So Meta on this 15-day streak, I've been talking about that incessantly. That's crazy. It's up 22% this year, record highs galore. Amazon up a respectable 4%. So is Berkshire Hathaway, but Tesla coming off its worst week since I think October, somewhere in there. Apple down 9%. So we have this rally underway, but we haven't seen the participation from some of the big guys.
So even without Mag 7, though, my friend, major indices, the popular averages we love talking about, you're still near records.
Yes, we are. And just take a look at the sector action year to date. So I like to measure since the inauguration as well, but this will do. Financials, 7%. Healthcare, not even close behind, or close behind, that's up 6%. Communication services, that's a Meta story, that's an Alphabet story. Materials, industrials, energy, there's a lot of sectors picking up the slack. I'd also add utilities and real estate. Those are also outperforming the S&P 500, which is up only 2.5% this year. So what do they say? They say rotation, sector rotation is the lifeblood of a bull market. So that's what we're seeing here.
What about Jared Blickery, point number 2?
Let us go there. This is commodities because they are going wild. And I just got to show you, not all commodities, I got to show you what's happening with some of them. And for some of them, this is a year-to-date look. Like coffee has just been on an absolute tear. 13 record highs in a row. This is just the intraday price action. Let me show you a one-year chart. There you go. Palantir-esque, my friend, maybe. It has been breaking out, has been consolidating and breaking out, and that's just been the pattern here, and that's what we see in a bull market. But critically, we're not seeing this in all commodities, but we do have the makings for something bigger here. I'd throw out that copper is up 15%. It's up 5 days straight. Gold, where is it on that list? Here, it's up 8%. It's been hitting a lot of record highs recently. Here, this is a one-year chart. All of these have been record highs. So when the Fed is on pause here, that provides a backdrop potentially, or cutting rates potentially for commodities to excel. We're only seeing it in pockets here, and I'm just kind of waiting for another thing to drop.
You mentioned copper, Dr. Copper, the red metal. Any implications for stocks?
Yes, we have some 2025 trades. I'm going to call these the sleeper trades, and I've talked to a number of guests. They might be macro investors, they might be technical investors, but I'm getting healthcare a lot. A lot of people are interested in healthcare. I'll get to that in a second. I want to stick with copper because that is a China play. So let me bring up our China heat map. This is year to date, and we can see a lot of green in here. And there's been a lot of excitement over China since September of last year when they announced their bazooka QE, fiscal and monetary measures. However, they've been released in fits and starts, and there's been a lot of people saying China is uninvestable. But I think it's if you do believe it's an investable case, we're probably on the verge of a big reversal here. It's just been beaten down for so many years. Also, healthcare. We brought that up. I want to mention that we did have a Stocks in Translation guest, Nick Colas, and he was telling about us why he likes healthcare currently. Let's take a listen.
I think the best hedge on tech is healthcare. Investors tend to look at, growth investors tend to look at two sectors in depth, tech and healthcare. Tech has really stolen the ball over the past couple of years. Healthcare got crushed last year on a whole range of issues, policy as well as fundamentals. But I think healthcare is really attractive here.
All right, so healthcare, also China, maybe Europe, maybe it's time for Europe, maybe not, but that's
Europe.
A good one. Yeah.
Give it a maybe, a maybe.
You got it.
Thank you, Jared. Thank you, buddy. Stick around, much more Ask for a Trend still to come. When the NBA's new collective bargaining agreement fully kicked in this season, the prevailing wisdom was that it would stop or at least slow down the movement of superstars between teams. But after one of the wildest trade deadlines ever, it turns out that couldn't be further from the truth. Joining us now is Joe Pompliano, Yahoo Finance Sports Report host. Joe, great to see you. So, wild week in the NBA, Joe. And you know, you think about that new CBA, it was designed, Joe, to stop superstars from switching teams. But now Luka is a Laker. Jimmy Butler is a Warrior. What happened here, Joe?
Yeah, I mean, you just mentioned it, right? This move alone is going to cost Luka Doncic over $100 million. If you think about the contract by itself, he was going to be eligible to sign a Supermax extension, which would have been the largest contract in NBA history this offseason. But by trading him, he's no longer on the Mavericks, of course, so he's no longer eligible to sign that extension. The deal with the Lakers will be worth $117 million less over the same term. So he'll make some of that up with endorsements, but he's also going to be paying a much higher tax rate in California versus Texas as well. So there's certainly a lot of money at play from the player standpoint, but also at the team aspect, a lot of money has been changing hands and the prices have been differed because of this trade. If you think about ticket prices, LA's ticket prices are through the roof while Dallas's are falling. If you think about collectibles, his name was being searched more than 80 times a minute after the trade took place on eBay. The same can be said for endorsement partners, sponsorships, all of that stuff as well. So it's been a wild time the last few days for the NBA, trying to steal the spotlight a little bit from the NFL with the Super Bowl. But I think Adam Silver probably has to be happy with how things played out.
Switching gears, Joe, one of the things this trade deadline did was make people, at least some people, forget the Super Bowl is actually this Sunday. Joe, what are you going to keep your eyes on?
So there's a few different things. One of the most important things is that commercials are now at $8 million, right? That's price has steadily increased over the last number of years, but Fox was able to get a number of brands, at least 10, to pay $8 million for 30-second slots. We see that the Super Bowl is still the best option to go advertise in front of hundreds of millions of people, right? The Super Bowl last year had more than 120 million people. The expectation is that it'll be the same this year as well. The other thing I'm keeping an eye on is ticket prices. I know some people have seen headlines over the last few days, and it's actually gotten worse. Ticket prices are down a lot over the last few years. I think down over more than 60% from last year at this same time. So ticket prices have fallen. A lot of people have said maybe that's, Chiefs fatigue with them winning 3 consecutive or getting to 3 consecutive Super Bowls. But I really don't think it's that. If you think about the AFC Championship game they just played last month against the Buffalo Bills, they literally set a viewership record with over 57 million viewers. So I think it really more has to do with the hotel room situation in New Orleans. If you look at New Orleans, they have less hotels than every other major city that hosted a Super Bowl. I think they have about 25,000 hotel rooms compared to 100,000 in LA or some of the other places like Las Vegas that have hosted Super Bowls recently. So those prices are significantly higher. When you think about families with fixed budgets, it creates a sort of supply and demand imbalance with how much money they're willing to pay for a hotel versus a ticket.
Joe, thanks. And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report, dropping every Thursday at 5 p.m. Eastern. Here's a look at the newest episode.
Roger Goodell does his annual press conference during Super Bowl week, basically to give a State of the Union on the NFL. He touched on a variety of things earlier this week, from concussions to the international schedule to officiating and things like that. Is there anything in particular during that press conference that stood out to you?
A couple of things, Joe. Number one, the 18-game schedule. I have sort of said the way it's being talked about is kind of nonchalant, and they would have to steamroll the NFLPA, the union, to get that. Of course, the players have to agree to an expanded schedule like they agreed to a 17th game in 2020. He was a little more, I guess, submissive to the union than I've heard before. Like, no, it's not happening right away. We've got to talk to the union, and the next CBA is not for several years. So I think this fait accompli about 18 games, according to the commissioner, is not necessarily going to happen anytime soon.
Time now for what to watch next week. Starting off on the earnings front, we're going to be hearing from a lot of big names, including McDonald's, Coca-Cola, and Shopify. McDonald's posting results for the fourth quarter before the opening bell on Monday. Analysts anticipating same-store sales to drop in Q4 from weakness across key markets and an E. coli outbreak that likely caused significant declines in November and December. Moving over to the Fed, another round of Fed commentary coming throughout the week. On Tuesday, Fed Chair Jerome Powell is testifying before the Senate Banking Committee. Powell then talking to the House Financial Services Committee on Wednesday. And taking a look at the economy, we're getting some fresh inflation data next week. On Wednesday, the Consumer Price Index will be coming out. Economists forecasting total CPI to slow to 0.3%, core CPI to tick up to 0.3% on a month-over-month basis. Then we're going to be getting fresh Producer Price Index numbers. That's on Thursday. Both total and core PPI expected to tick up by 0.1% month-over-month. That's a wrap on today's Ask for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.